Hello guys, Steven Dux here. Welcome to this YouTube video. So today's video we're going to cover how to really look at a stock in a simple way. Before I start this video, we have a conference coming up in November 14th to 16th. So will be the next 2 weeks. If you are interested in this day trading industry or you have been trading for 1 or 2 years, it's going to be a really good experience for you guys to come to hear 3 of our traders share our experience about especially this year, how to really adapt into the market, and we are going to review some of the new patterns as well. So before I start this video, make sure to hit that like button and subscribe. It's going to really help our YouTube channels. So let's get into the main content today. If you are a total beginner and you are gathering information from all of the sites like FinViz, Yahoo Finance to get a statistics on a general stock you're interested about, and there's all kinds of different statistics about the stock, and there's only 3 things you need to know: volume, float, and market caps, because those things can directly affect how you place a trade on a certain ticker. Now first, let's talk about volume. Volume generally means how much demand is in the stock currently. So let's say the stock traded about 100 million shares today, and that's considered a very good volume or almost very crowded, and that indicates the stock has a really good demand. Secondly, let's look at float. A lot of people are confused between float and share outstanding. Share outstanding means the total outstanding shares is in the stock. And the float means the total amount of shares you can trade by investors like you and other people wants to invest into the stock. They're not insiders. So float is the most important thing you want to look at. Share outstanding doesn't really matter at all. In this case, float means the supply. When you are trading a stock, it's a very simple supply and demand question. It's because if you can figure out the demand is overwhelming the supply, then the stock price definitely going to increase. So that's the relationship between volume and float. Lastly, let's talk about market cap and volatility. Generally, market cap can take a big effect on volatility itself. So a lot of people are confused about market cap and volatility. Let's explain them one by one. So market cap, normally I split them into 3 different sections. Now it will be 0 to 100 million, that's one section. 100 to 500 million, that's the second section. 500 to 1 billion, that's the third section. Now the fourth section, which I don't normally trade at all, so I kind of ignored it, but the fourth section will be 1 billion or up. And when you want to focus on the day trading industry, you normally want to stay in the 3 section between 0 to 1 billion. The second thing I want to talk about will be volatility. Volatility means how much range the stock can create in that day. So normally you see a stock drops 70% from the highs in one day, and you see a stock just dropping maybe 2 to 3% or move out 1 to 2% in one day. So that's the reason why volatility can create large amount of profit, and that's also the main factor of a lot of traders can make $50,000 or $100,000 in one day, and that's they are taking advantage from the volatility. So how does market cap and volatility relate to each other? Let me give you a solid example. So first of all, when you are looking at the entire day trading industry, it's almost 90% retail investors. There is a total amount of dollar can be traded in one day if you are really trying to focus in this specific industry, not into the billion-dollar cap. So if there is a total amount of dollar can be only traded in one day, then when you are putting this dollar amount into a bigger cap, it's not going to affect the bigger cap stocks very much. Let's assume the total amount of dollar can be traded in one day will be 1 billion. Then we put it that $1 billion in a $100 million cap. You can make that stock go for 1,000% before it drops. Now let's put them into a different condition. We put $1 billion into a $1 billion stock. That can only make the stock go up 100%. So the higher the market cap is, the harder it's going to make the stock move based on how much money is being traded in this industry. And let's try to put all of the factors together. We have demand, which will be the volume. We have supply, which will be the float. We have market cap, which will indicate and tell you how much volatility you can create in one day. So how do we use all those 3 factors together to generate a decent method to really benefit your trading skill? So I'm going to explain one situation you can use all 3 factors together and just listen carefully. If you understand, make sure to leave a comment below. If you have any questions, also leave a comment below. I will get back to you as soon as the video is posted. So here we go. Normally that we see a stock can go from 1 to 5. First of all, we can use the concept that we know there's a total amount of dollar can be traded in one day. So we place that in a stock. Let's say the stock is 100 million. It can go maximum 1,000%. So we have that idea of, okay, this is the maximum the stock can spike to, $1 to $10. And all of a sudden we have a massive consolidations at $10. Then how can we use the volume, which it will be the demand, and the flow, which will be the supply? How do we use those two factors to predict where the stock is going to drop? So we know the maximum that stock is going to trade $1 billion in that day, spiking from 1 to 10, 1,000%. When we have a massive consolidation, which will be a flat line, and it's trading tons of volume, that also means the shares are exchanging hands back and forth. So if I bought at $1, I'm selling at 10, and if you bought at $2, you're selling at 10 as well. Because the longer it consolidates, it actually makes buyers nervous. As soon as the stock decides to crack, or even a little 15% or 5% move, nobody wants to be the last one to sell, because when you are the first one to sell, you will get the better execution. So if you bought at 8, and as soon as the stock pulls back to 2%, you are eager to sell. So the longer the consolidation is, that means all of the buyers are switching from 1 to 10, because the reason why stock didn't drop is because people are buying at 10. All of the shares are slowly exchanging hands from all of the prices to the $10 mark. Now we know the golden rule of the market is 90% of people are generally going long, and also 90% of the people are generally losing in the market. So the more volume is trading that consolidation, the more people are holding into that consolidation, and the more people are buying in that consolidation as well. Eventually it will turn out 90% of people are holding the entire float, and that will cause a massive drop. In this case, you are using all of the three factors together. You are using the demand, which you are using the volume to predict where the stock is going to drop, and also you are using the supply, because the more volume you trade, if the flow is rotating 10 times, 15 times or more, that tells you most of the people are holding at the same level. Thirdly, market caps. Generally, when you are trading under 100 million caps, most of the companies are generally penny stocks. And by using all those three factors together, you can kind of predict where the stock is going to drop, and also predict the volatility as well by using all those three factors. Alright guys, that will be the end of this video. The last part is a little bit complicated, so if you have any questions, please leave a comment below. Thank you very much for watching. I will see you guys in the next one.